allocators. Today we'll be discussing how to optimize hedge fund exposure and risk of monetary and geopolitical uncertainty. I'm Eric Uhlfelder, founder of Global Investment Report, and for more than 20 years I've managed and have written global hedge fund surveys for the Financial Times, the Wall Street Journal, Barron's, Institutional Investor, and SALT. For the last 5 years, starting with the 2019 edition published by the journal, I transformed the survey into a search for consistency, not who's managing the most money or who had the best year. The result is a list of the most consistently performing funds, which you can see on my LinkedIn page. Today, I'm honored that my fellow moderators include Anna Niziol, former Chief Marketing Officer and Head of Product Management at Rothschild Co, and Linus Nielsen, a systematic hedge fund trader and founder of the alternative investment database Nielsen Hedge. Our panel includes Cédric Dingens, Head of Alternative Investments at Anna Partners, formerly Stuckey, Jim Neumann, Chief Investment Officer of the London-based consultancy Sussex Partners, and Justin Young, Director of Investments at MEMCO and former Director of Investments at the South Carolina Retirement System. Welcome to all. So let's get started. And first panelist, let's just describe your main client base. Cédric, would you like to start off, please?
With pleasure. Thank you, Eric, for the invitation, and welcome everybody. I'm heading the alternative investment department at Anna Partners. We manage more than 11 billion of assets and 3 billion in hedge funds.
And the client base, please, generally?
Yes, mainly private clients with discretionary mandates. We work with 50 banks all around the world. So that's our core, asset base.
Very good. Jim?
Hi, everyone. Jim Neumann, Sussex Partners. We are a hedge fund consultancy based in London, Zurich. I'm in New York, and we have people in Tokyo. Our main functionality is to advise institutional investors ranging in size on the small side from single-family offices to large institutions you would know on their hedge fund allocations, ranging from UCITS funds out to longer dated hedge funds.
And Justin.
Hi, we're a nonprofit investment team. I guess OCIO is probably the best title for what we do. And we manage for other nonprofits. Within the hedge fund portfolio specifically, we have 3 different portfolios. One is directional hedge fund strategies. And so it's historically a lot of long short. We moved that into more diversifying directional strategies like reinsurance. We've got an RV portfolio, which is for higher vol, and then we recently rolled out a portable alpha program. So that's where I spend the majority of my time on those 3 parts of the portfolio.
Very good. Let's address the elephant in the room, and that's the election coming up. Please compare market and geopolitical risk between a Trump versus a Harris administration and how each might affect the way you invest, generally and specifically in hedge funds. Cédric?
Yes, with pleasure. To be honest, when we select hedge fund managers, it's like a delegation of a mandate. So we don't really care in the sense of who will be the next US president. And what we want from our hedge fund managers is to adapt to the new reality. It's quite funny to see that. If you look at the Trump era versus the Biden era, and you look at, for instance, the performance of renewable energy stocks, it was the opposite of what you could have thought about. So it's not so easy to try to make bets, depending on politics.
And Jim?
So I'd point out first that there's both an elephant and a donkey in the room. The outcome is seeming more uncertain, and obviously there are certain plays that the managers will make themselves based on anticipated both presidential and Congress outcomes. Hedge funds, in our view, are kind of meant to be all weather, so we don't kind of take them to make bets on individual events, particularly on elections, no matter how important they might seem to the economy. The uncertainty argues for lower beta portfolios in our view, just going through this period and with our moderation until we kind of figure out what the makeup of the government's going to look like in the U.S. And therefore what the makeup of the fiscal and the monetary policy is going to be. In the last go around, the fiscal spend really dominated and really drove the markets, and the monetary policy, I would say, a close second to that. There's a lot of discussion about regulatory environment, depending on the outcome of the market, and that would certainly have an effect on corporates and their ability to produce profits, and thus the hedge fund managers' ability to pick the winners in that. The House and the Senate is obviously critical, whether it's split or whether the president has control of both.
Thank you. Justin?
Yeah, I'd echo what Cédric said. We build our portfolios strategically, and so really thinking about the relationship between the underlying strategies. I think on the margin, my job would be to think about where within the portfolio I want to allocate, and so which strategies might benefit more than others. And so on the margin, it could present opportunities for macro. I mean, we certainly saw that in 2022, how geopolitical concerns certainly created conditions for more attractive macro conditions, divergences in central policy, sort of the implications from stimulus and, sort of Russian war and how that played into energy prices. I think looking ahead, it's one, I'd say like there's certainly lots of implications, the Middle East, trade, energy policy, particularly the dollar related to trade. But I'm not sure a lot of that stuff will be as impactful without the support of Congress. And so when I'm thinking about where I want to be able to move nimbly in maybe the first 3, 6, 12 months of the new administration, one area I think could be quite interesting is merger arb. And because that is under the purview of the president or the FTC and sort of regulatory agencies. And so I think that Lina Khan has been particularly aggressive towards mergers recently. And so I think that's an area where you've seen some elevated premia. Some of that could come in with a shift. And so it's probably the most direct strategy where I think a shift in the president could have a pretty clear impact on the underlying strategy set that we focus on.
So it sounds like none of you believe much of the extreme thinking that a volatile Trump administration could create different investment opportunities or risk going forward then.
No, I think there's a difference in saying that it can create opportunities, but how would we change our strategy set? I think Cédric and I were saying the same thing. I don't want to speak for him, but in general, a divergent opportunity set doesn't necessarily mean that you need to change your portfolios if you've got managers that can respond to that appropriately.
Interesting. Linus?
So I had the opportunity to spend some time on your side of the table. I was, as a former allocator, I did a fair amount of mistakes. You always invested in the wrong manager, but eventually sort of it came out correct. So what do you think is the most significant error that the allocator community is making when it comes to investing in hedge funds? Is the initial due diligence phase more important, or is it sort of the ongoing due diligence that actually uncover flaws in your original investment thesis? Jim, maybe I should start with you.
Sure. I'll kind of combine my experience with that of our client base. And I think the biggest issue is well known to everyone. It's really performance chasing. So trying to go find the hot manager, the hot strategy that's putting up the returns in the last quarter, last half year, last year. And then kind of glossing over then the due diligence process a little bit while staring at those juicy returns, or we call it the shiny thing that seems to get everyone's attention. A very thorough due diligence process is designed to force the allocator or the end user to stick with a proven process. And we try to do that ourselves. So we try to take out some of our bias or our distraction within the process. Included in that, it's kind of very solid operational due diligence to eliminate as much of the non-investment risk as possible. And on the ongoing, you have to regularly re-underwrite what you've done and reevaluate it. at a reasonable period. So what we do is kind of a monthly IC meeting, and at that IC meeting, we literally go over every single allocated investment and not do a full re-underwriting, but a full discussion of it, including performance changes to manager, changes with the strategy, et cetera. So it's a very ongoing process. It doesn't stop at the initial due diligence.
Thanks for that. Justin, would you like to add a few your insights on that as well?
Yeah. So my fundamental view on what is an alpha space like hedge funds is still everything is beta. And it might not be market betas, but they're sort of like sub-strategy betas. I'll just take an example, like take late 2020 and take the event and credit RV managers, for instance. And they leaned into SPAC RV, for instance. That sort of trade, just running that naively, made somewhere between, depending on how much leverage you had in your book, somewhere between 30 to 60% over about a 6 or 7 month period. And so if you were a credit or event manager and you had like a PM that could do that, and you size that up to, say 20% of your book, you made an extra, 10% versus your peers. I think really and this is the answer to the question, is really taking the time to go into the weeds and really understand what drove performance. Was this like really idiosyncratic, sort of really creative, thoughtful, meticulous trade construction, or was this some sort of like unlikely to be sort of replicated sort of part of the market that delivered sort of outsized returns for a short period of time? I think understanding what is driving that sort of performance is very simple to do, but I don't think if you ask, when I talk to my peers, sometimes I ask them, why do you like this manager? What intrigues you about them? And they often will point to performance or something, but sometimes don't have a full grasp of like, oh yeah, but it was really these 2 or 3 trades or this sort of sub strategies that differentiated them, rather than just sort of consistent high alpha generation sort of through the cycle.
Thanks for that. I already hear we have 2 very different perspectives. Maybe Cédric can deliver a third one.
No, but I tend to agree with what Jim said. I mean, in the sense that sometimes there is a misunderstanding of the potential behavior of the return expectations from a manager. And the second point also is we should try to be a little bit contrarian, in the sense that, for instance, macro managers did very well in 2022, and a lot of people tend to think, okay, it's time to increase macro, and actually it's not the good time to increase macro. So it's very difficult to do that. So we should be careful and most think long-term, basically, on strategy allocation.
I think that actually ties into Eric's next question, so I'll hand it over to him.
Thank you, Linus. For a number of years, I had spoken to Goldman Sachs' Ken Clark well before his untimely passing. And he headed the firm's alternative investments and felt that hedge funds are not long-term investments, that rotation is key to sustained performance. Do you believe that some managers may be good for the long term, or that regular rotation is inevitable? Justin, would you like to start off?
Well, I think that's a fair characterization of the industry as a whole. That in general, managers tend to be, particularly successful ones, if they're twice as good as their peers with half the risk, they can just double their AUM and not do anything and dilute the returns and have a pretty stable business model that will keep clients around. But I definitely think there are, and I'd say this is probably more true among quant managers than discretionary managers, but tend to have quite a bit of persistence. I think there's, I can name several, multi-billion-dollar firms that have been doing this for decades that continue to be best in class. And so I think what it requires is, like, from an allocator, are they maintaining the same level of gross exposure? Are they maintaining the same level of innovation that they did in their early days? And so if you bring on a new $1 billion, do you have a new $1 billion worth of interesting, high quality, sort of strategies to deploy it in? And if you don't, then I think that the general course of a lot of hedge funds is to sort of just become much more like the median hedge fund, which will probably keep them in business for a long time, but not deliver outsized returns for investors.
So it sounds like you believe rotation is inevitable over a period of time, and that sticking with funds that can produce consistently is not altogether likely for most.
I think, it's like, I think I think most hedge funds, I'll give a more real sports example. I think they're more like quarterbacks than they are head coaches. They'll have a few good seasons and then they've kind of reached their peak, and then their strategy gets a lot of competition. They raise too much AUM, the environment changes. But there are definitely, like, take a football example, like the Nick Sabans out there that can do this for decades, but that requires quite a lot of leadership and structure. And, so I won't deny the existence of exceptional individuals, and I think that there are plenty that you can point to, but I think they're probably the 10% case, whereas most people are 90.
Yeah, I remember the line about Notre Dame in the 90s or even later saying they don't rebuild, they just reload. And it seemed like they were just the team to beat all the time. Jim, sustainable investments in a hedge fund, or is rotation inevitable?
So I think Justin's comments were pretty well balanced. When we talk to investors, we tell them to expect about 20%-ish turnover, and that will increase during more volatile paradigm shifts and type periods. We do hope to have a stable core of managers that we can invest with over a period of years. And I recognize that at some point, AUM becomes too large, or they're catering to a very specific investor group that is satisfied with perhaps lower returns and lower volatility, and that may not fit the mandates that we're trying to do. All our mandates are very bespoke, so it may be they would want a fresh, higher volatility manager in the portfolio rather than a steady, stable, high sharp manager with a lower return going forward. One has to carefully consider access, and be careful not to be biased against making a change even in a manager that's closed or it's hard to access. I'm not saying that you shouldn't give a little more leeway to those managers, but you probably should. The hedge fund managers do themselves. They'll trust their star PMs to dig themselves out of a hole or be able to handle the risk management portion. And I think that is the case with the more pedigreed managers, that they do get a little bit more rope. But you have to always look into what the reasons are for any kind of a change in return profile.
Well, if we can, we might address the issue of redemption at the end of the webinar. Cédric?
No, I definitely think that hedge funds are long-term investments. When you have a good selection of good hedge fund managers, you should stick to that. And over time, it's funny to do the exercise of you built a portfolio 10 years ago, and obviously there are different life cycles and so on. So of course, but and to see the performance of your portfolio if you did not do anything, no turnover, and what you did also in the portfolio in terms of new manager selection, etc., redemptions, and to see the difference in terms of return. It's quite funny sometimes, but so long-term investments for me.
Very good. Linus?
So actually, I would like to tie back to the sort of this discussion. Eric has managed to sort of compile a list of sort of really good long-term consistent performers. But there are also other ways to sort of optimize your portfolio. You can sort of seek the more diversifying managers. You can seek to maximize the efficiency of your own sort of hedge fund portfolio. So what do you put the most emphasis on? Do you put it on the long-term standalone performance, or is it more the diversifying characteristics of each manager? Maybe I should throw that back to you, Cédric. You had some nice insights in your prior answer.
Yeah, I mean, definitely it's a combination of both. So I would say that first of all, we manage different pools of capital, so with different mandates. So you could have, equity long short, macro with long track records, well-known names, and with a low turnover, I would say. And obviously, you try to find also new good managers with a lower track record, a lower AUM base. And it's like a little bit of farm team, if you like. And then you see a little bit, you try to do first tickets and see the evolution. But the idea for us is there not to miss a new launch or a new good manager, even if there is no track record to start with. So it's a combination. And I would say then you have to stabilize, and the best ones obviously become high allocations in your portfolios, and that's how it works.
So a follow-up question: what would qualify you to be on that farm team?
I mean, farm team, definitely it's emerging managers, okay? And it could be also in more niche strategies as well, with less scalability, for instance. So yeah, I mean, it's on a case by case, you know, it's difficult, I mean, to try to categorize all hedge fund managers. So then obviously, I mean, all the art is to try to combine everything together to make sense. And also to have a minimum of diversification, for sure.
Okay, thanks for that. Jim, would you like to add your insights here? So
Yeah,
what do you focus on?
Trying to measuring the long-term consistent performance is an important metric. It's one of the inputs into the return review of a manager, but we don't want to rely completely on the returns. I mean, generally speaking, we have a lot of clients come to us with the same managers again and again who show up in their screens with all the right stats. And a lot of those managers, when you dive into them, they're doing something to produce that consistency that doesn't necessarily make sense from an investment standpoint. And in more than a few cases, that's ended in tears if the manager was doing things like shorting volatility or doesn't know they're short volatility and then has a problem. So, you know, 5 years of steady, you know, high sharp returns followed by a very difficult period, you know, in spectacular fashion sometimes. So we do try to avoid, you know, strategies that have a potential for negative skew, in particular when we do dive into them, when the return profile looks attractive, we discover something that can't either be understood or that we don't like. That a profile that could end badly and have a big skew to it.
So is there when you actually do your due diligence on manager, is there anything else that you would like to highlight except for the potential for negative skew or short volatility exposure?
Look, I mean, we're all kind of in the returns-based business, so we do a fair amount of analysis on the data that we have. It's often return-based analysis. So, you know, we select managers on a single standalone basis, but we also select them as part of a portfolio. So we look very carefully into how a manager from a return standpoint and a risk standpoint fits into a larger portfolio for a client to achieve their objectives. So returns are important, but, you know, also the qualitative assessment of what the manager is doing and what the likely forward-looking outcome might be.
Right. Justin, as last man out, you have any? Would you like to share your insights?
Justin, you're on mute.
Sorry for that. I think it depends on what specifically you mean by the word opportunistic exposure. If it's like a new market that may or may not be persistently attractive, I tend not to chase those. I mean, just assume that it's a small manager. The problem with emerging managers is that you have to make smaller allocations. So say they outperform by 5% versus your peers over a 2 or 3 year period on 3%. It's 15 bips or something. It's like, and then you multiply that times a 10% allocation to hedge funds, and it's like 1.5 bips at the plan level. I try not to chase those. But if it's a market that's like structurally disorganized, so take something like a muni bond RV manager versus a fixed income RV manager, like in treasuries, there's like a 200 or something treasury bonds versus like tens of thousands of munis. Like there seems to be there's a real argument for why like there might be more alpha in a different market. And so I think I'd be more likely to chase that when I can see a long-term impact. I think so. That's the second piece. And then there's also managers that are just smaller and like, the same way that a car can, move more nimbly than like a semi truck can. I think that if the manager is running higher levels of gross leverage, they're being more tactical, they're moving in and out of markets. Maybe they have 2 or 3 analysts or, sub PMs that they work with and they can move across markets. That's highly attractive, but then that will only last a few years as well. If they continue to grow, they're going to look more like their larger hedge fund brethren. And so I just add a little nuance to sort of how I think about emerging managers or the utility of them, and then, within a long-term sort of hedge fund portfolio.
All right, I would like to hand it over to Anna. That's going to switch up the topics. We're going to move over to AI.
That's right. I don't believe we can have a meeting without talking about AI. As we know, AI, it's on everybody's mind these days, and it's definitely transforming various industries. And let's be honest, financial sector, it's now no exception to that. So I have two questions for you. One, can you share with us if you incorporate AI in your fund selection and management process? And the second question is, it's when it comes to the hedge fund managers. So do you see hedge fund managers leveraging AI, enhancing their investment strategies and operations? And in particularly, I would be interested if you see a change in terms of applying AI in risk management. Let's start with Jim.
Sure. So obviously AI is an important topic, and it started out maybe 5 years ago for us with a lot of chatter about it and a lot of managers trying to attach themselves to it in some form or fashion to raise AUM, adding a little sizzle to whatever they were doing. We generally see the AI and machine learning being employed more in the quantitative strategies now by the managers, but on the forward-looking thing is that it's going to be used much more frequently on the execution side of strategies that require a lot of document review, a lot of news review, et cetera, to give them an edge in that. The quantitative strategies, we typically want AI to have some kind of solid basis in financial theory and not kind of run amok, if you will, and be able to go down any kind of path that it sees in the data. So we're a little bit careful about that. We probably have exposure to 2 or 3 quant managers that have started out in a more traditional quant area and then kind of migrated it over to be more kind of AI focused and AI driven model evolution basis. And within the our due diligence process, we will only see it show up as the software improves in order to review return and the risk management of the manager.
Thank you, Jasmine.
I think I echo what Jim was saying about quant managers deploying AI. They've certainly been, at the forefront of it. I mean, but it's definitely permeating the industry. I was speaking with a private debt manager a couple of weeks ago who said like their HR department came back and they had penciled in 3 people to hire for that year, and they didn't need any because of the new tools that they've added. So I still think we're in the very early innings. I mean, I think ChatGPT kind of came out and it's not even been 2 years. I think it was the fall of 2022. And so I think everyone's been scrambling to incorporate, sort of that type of functionality in their business. We just rolled out a local LLM for using it to evaluate sort of manager materials, and it's functioning just exactly like I would expect, like a second or third year analyst to that sort of that level of performance. You can ask it questions, it can find things in docs, and I like this local model because it like focuses directly on the document, so you can eliminate hallucinations. So when you ask it what is a manager's fee structure, like it'll just take you to it'll spit the answer out and take you directly to the document, and so sort of producing expository text. But I think there's an amazing amount of things that it could do, and we're not quite there yet. But I expect this to continue and probably mean fewer people in our industry as a result over the next sort of 5 to 10 years.
Cédric?
I think it's still early days for AI, definitely, from what we see when we discuss with managers. And with regards to the fact of using AI to select hedge funds, we don't really believe in that. I mean, we think that it's a people business and will continue to be so.
So you don't believe like somebody predicts that analysts will not exist anymore? They're going to be completely replaced with AI functions. You don't see that future coming.
Not convinced yet, but we'll see.
Thank you. So I will follow up with another question, and the question about fees. So obviously there's a lot of discussion about that, and as we mentioned in Eric's report, in the Global Investment Report Survey, top-performing funds heavily emphasize annual hurdle rate as a criteria for inclusion. So I think we all would agree that fee are very important in terms of selecting managers. So I have the following questions for you guys. How do you approach fee structure? And do you prefer managers who use hurdle rates? And if you do you like hard or soft hurdle rates? And if you can share with us, at what level do you negotiate or typically see the hurdle rate? And I'm gonna start with Cédric here.
No, that's a good question, fees. I mean, from my experience, again, I tend to think that, the best hedge fund managers have the pricing power. So that if you want to have the best in class, you can't really negotiate. You can't really negotiate fees. But this being said, obviously, when you are a long-term investor, you have a good relationship, you can benefit from rebates, I would say. So that's not negligible. Or to be in share classes with better liquidity terms, that's a different topic. But so yeah, it's on a case by case. But again, it's really difficult to negotiate fees with the best hedge fund managers, from what I see.
Thank you, Justin. What's your experience?
I think it's necessary. It's basically every hedge fund had a hurdle rate prior to the GFC. We had, every fund that launched under Bernanke and Yellen. No one asked for it because they didn't care. We'd been sort of primed. Fortunately, when I was at my old role, we did negotiate several hurdle rates, and those were hopefully yielding fruit for my old employer. But the last two, investments I've made, we did negotiate hurdle rates, and these were not small firms. These were, multi-billion-dollar entities, and so I think that managers are open to it. It feels a little wrong to have a higher performance fee for a hurdle rate right now, but with Cédric's point, the best managers are going to get what they want. But I would still rather have alignment there than not have it. And so, as you mentioned, most hedge funds, particularly those that are market neutral, they're generating a cash-like return on their short book. And so there's no reason that they should be earning, an extra 100 basis points or 150 basis points in this environment just because the Federal Reserve hiked interest rates. And so I think the way that it'll play out is, managers will have a run of 2 or 3 years of weak performance. The most impatient investors will start to leave, and they'll be willing to negotiate to keep them around. And I actually had a call this week with sort of the $5 to $15 billion range hedge fund who's done well, but they haven't been exceptional. And they're already announced to me, it hasn't been public yet, but they're going to roll out a hurdle rate. And so I think it's going to take time, and it'll be. It's going to happen. It's just a matter of when, not if.
Not if.
Except for the very best. There will be, there's, a handful, I could probably name on one hand, that won't negotiate at all. And I think everyone else will get there after a week stretch.
Jim?
So I think the pendulum of power swings back and forth between manager and investor. We're probably someplace more to the manager side right now, and maybe it's on the swing back side. In the past, we've been able to negotiate hurdles particularly for large allocations. The current level of base rates is obviously making the topic much more important, particularly in an environment where managers operated for a long time at kind of 300 over zero, and now to be 300 over 5% base rate. Obviously, a hurdle is kind of going to be more of a topic when rates aren't zero. So I think, to Cédric's point, a lot of the very pedigreed managers that are most desirable kind of don't negotiate. They certainly don't negotiate on hurdles, and hard or soft doesn't make a difference. But in concept, particularly with a higher base rate, the idea makes a lot of sense, and it does benefit the end investor.
Just a quick follow-up question. How do you guys still pass through expenses? Are obviously commonly associated with multi-strategy. What is your take on that?
So I'll start with that. I mean, it's, this is a big topic, right? The whole multi-strategy pass-through issue. And the question is, how do these firms operate in a more volatile environment? And the pass-throughs have gotten pretty egregious, and we've all read about some of the things that are getting passed through, including sign-on bonuses, et cetera, that only the largest guys are able to afford. So I think there will be a pushback at some point, probably based upon returns on some of these pass-through expenses. And the netting is a big deal within the strategy, and if that's being absorbed by the investor and returns aren't there, it does change the profile a lot and makes the manager have to make some pretty drastic changes.
Thank you, Justin. Now, Cédric, you guys want to add anything to it?
Yeah, I think there's definitely cases of borderline abuse on the amount of fees that get passed through. But actually, if you think about what a multi-strategy fund can do, they can run higher levels of gross leverage than you can get a manager to run. They've sort of cracked that nut. They can run a center book, further increasing sort of the amount of capital you get per dollar invested. They can fire managers more quickly because they have managed accounts. They typically negotiate hurdle rates over, they almost always universally have hurdle rates that we wouldn't be able to negotiate. The fees are lower for the underlying PMs, typically some sort of draw, but usually in the neighborhood of 0 and sort of 18 to 22. And then lastly, they can also tactically allocate quite dynamically. And so when you add up all those things, if your multi-strategy firm that you're hiring is doing those things, really they've reinvented the fund-to-fund industry it's a better mousetrap. I don't think it's unreasonable to pay them for that service. And some of them have clearly earned the value that they have charged. Their net returns are materially higher than the sort of strategy mix for the sort of the hedge fund betas that if you mirror the hedge fund betas that they allocate to and look at the returns, they've generated significant alpha. And so, I definitely think, again, there's cases where there's 500, 1,000 extra basis points. But when you look at when you subtract the pass-through, which you're going to pay regardless, if you allocate to a bunch of 2 and 20 funds, once you subtract that portion of the pass-through, the fixed expenses are not hideous for all funds. Sometimes they're quite reasonable. And the few that I've done recently, I actually think it's cheaper than if we had tried to do it ourselves and allocating to, because you have to eat the netting risk yourself as well. It's not like you can circumvent that. And so I don't think it's, I can understand why certain people see these numbers and their eyes pop out of their head, but at the same time, if you model out the actual fixed expenses for a 2 and 20, if you reported your performance fees on a 2 and 20 portfolio, I think people would be equally surprised. Sort of 10% on a 2 and 20 turns into roughly 6. That's 400 basis points for a 6% return. That's not going to make anyone particularly pleased either. But they don't report the performance fees on 2 and 20 funds like they see on a multi-strat, and I think really it's sort of a little bit of an ostrich effect as well for some allocators.
Cédric, I'm not sure if you want to add anything to.
No, I think everything was said. Thank you.
Thank you. Eric?
Okay. One of the unusual things I found out from this year's survey was emerging markets showed up more prominently than they had ever before. I had 6 out of the top 50 being emerging markets, and 4 of them, surprisingly, were credit. Just to remind folks, to make this list, you have to have 5 years of hurdle-beating performance, and then with all the other funds on the survey, be able to rank within the top 50. So 6 of them were emerging markets, 4 were credit. I just wanted to know each one of your thoughts about this kind of exposure at this time going forward, because I would not have thought, with interest rates rising and all the volatility and pain that many EM currencies are suffering from, that this was remotely possible. But these managers seem to have learned how to manage to de-risk their very risky asset class. Cédric, do you want to take off on this question?
On emerging markets, you mean credits?
How in credits, equity, if you wish, but I just had a surprising find in this year's survey of the consistent performance of many managers who made the list. Does that in line with what you see emerging markets, or do you still see them as a high risk, moderate return potential?
From what I see is that emerging markets are more difficult to trade today than 10 years ago. So I know that there is more volatility. I mean, the cycle between countries is quite different. So there are opportunities, definitely, on the macro side. A lot of elections this year, for instance, as well. But all in all, I don't think that the risk-adjusted return profile of such managers is as appealing as it was the case before. That's my feeling today.
Okay. Thank you. Jim?
So we get most of our EM exposure through macro managers with a specialization EM. We generally avoid kind of local currency debt, and we bucket that into our credit bucket, as you kind of alluded to. It's kind of more volatile credit with perhaps more spreads to play for, but it also has a fair amount of economic beta to it. It feels often very binary at times. It's either doing well or it's doing very poorly. So we don't take a lot of risk there.
Okay, thank you. And Justin?
I looked at the list. There's a couple managers in there that have a very differentiated approach, and so I think that's more of a alpha angle. Broadly speaking, EM is more expensive to hedge. It's harder to stay market neutral, and so the fact that they're all credit managers, we've had pretty attractive carry. EM economies were pretty far ahead of the Western economies in terms of hiking. And so you've had pretty attractive returns. I'm not sure, forgot to look back on your survey, but it wouldn't surprise me if we've had a really good last few years among managers that have had an emphasis on credit.
Okay. Thank you, folks. And Anna's going to now speak about ESG.
That's right. Another, for some, controversial, for the other, well-accepted principles. So let's talk about evolving landscape of ESG investing. We all know that in Europe and many countries in Europe, ESG has been widely embraced and accepted and implemented. In US, it continues to be a topic of debate. So some people will argue that ESG can be actually a powerful tool for early risk identification, and Boeing probably being one of those great examples. That what happened if people identified the risk earlier? Would they avoid the potential disaster there? So my question for you is, first of all, do you incorporate ESG principle in your portfolio management, manager selection? That would be my question. And also, and if you do, if you can just give us a little perspective on that. And also, do you actually see, or does ESG influence in any shape or form your ability to secure a client mandate, especially given the difference of approach to ESG in Europe versus US? Let me start with Jim here.
So I'm going to start with the last part of your question. We have been approached in the last year and a half by clients looking to solve their ESG problem, if you will. And along that line, we spent a fair amount of time looking at managers with some kind of claimed specialization, Article 8, Article 9 within ESG. Our conclusion that we drew through the clients was that it was much easier to operate within the E of ESG, and then even more specifically, go to more of an impact approach to the space, and further distilled from that, go to the UN Sustainable Development Goals and try to pick those that attack the environment there and the impact. I think our conclusion was that we were able to create portfolios that were not ideal from a return and volatility standpoint within the hedge fund universe, but that we were finding better funds outside that more in P style that had that kind of impact and focus. The clients in general that we dealt with really didn't want to sacrifice return for compliance with ESG or focus on ESG, and that was a difficult balance to deal with.
Thank you, Cédric. Your from a different part of the world when it comes to ESG. If you can share with us your perspective.
With pleasure. I mean, it depends on the strategy we are talking about. There are differences, obviously, between hedge fund strategies. So it's clearly something to be considered for equity managers or equity long short, but not for global macro strategies to start with. And then if you consider ESG, obviously the G, governance and management of companies. I mean, it's already a key component of the analysis of a company for a manager to invest, to be long or short a company or a stock. So, I mean, what we think is that clearly ESG is a part now of the way to invest from a lot of institutions, and especially in Europe, as you said. So it has become a factor which has to be considered when you look at flows and where people are investing in terms of sectors, etc. So it's an additional factor that you can use to be positioned in your portfolios. That's more the way we see it today.
Thank you. Justin, I don't know if you want to add anything to that.
Yeah, I would just say we don't have any clients that have asked us to manage ESG mandates, so we don't really have a dog in that fight or strong views. But I do think it's interesting. We have, I think MIT actually came out with, they did a study called the Aggregate Confusion Project, and they noted like things like credit ratings are about have a 0.9 correlation. And they looked at the correlation across ESG ratings, and unsurprisingly, it was like a 0.5 correlation. And so, things like G are fairly straightforward. Investors have used those for decades. Environmental issues are a little more clear, like where maybe consensus might be on those. And then things like the S, like people just have different views on what that's supposed to mean. And I think that's why it's been so divisive in the US with certain states going in different directions. And I probably would be, I saw one state recently in the Northeast actually said, we're going to stop using the term because we don't think it's helpful. And, what is the goal anyway? Like if you divest, you've sort of, prevented yourself from engaging with that company anymore. It's sort of like saying, I'm going to fix democracy by stopping voting in some ways. And I think people need to really, I can totally understand the sentiment, but I think people are scrambling to feel like they're doing something sometimes, but maybe a more tailored, bespoke solution for each client might be a little bit better that reflects their needs rather than saying we have a 3-letter answer for your problems. I think maybe the same way that we have customized investment policy statements, maybe a customized sort of, whatever term you'd like to use, it sort of reflects basically is more principles that sort of beyond the bottom line might be a little bit more needed than just saying we have 3 letters that we're in compliance.
I mean, there's definitely tons of subjectivity when it comes to ESG rating, as you said, Justin. Thank you so much. So I think on that note, we are going to go to some questions that we got before the webinar, and also some questions that we just got during the webinar. So if you wouldn't mind, I'm going to start with a few questions that we got during the webinar, and I'm going to post them on our wall. So the first number here, what would be your wish list for the right stats in hedge funds that you would want to add to a 60-40 portfolio?
Well, I think I'd say the 2 stats you'd want to look at the most are the volatility. If you look at the beta of the correlation of a 60-40 portfolio is still going to be 1 to equities. The beta is probably closer to maybe 0.5, but it's not going to be that different than the 60%. Just bonds don't have a lot of vol if you've got 10 years of duration. You've had a little bit of vol in the last few years. And historically, the last 10 years, you've had some negative correlation that's reduced risk, but the long-term steady state of bonds and stocks has been slightly positively correlated. So if you think about what you want to add to that mix, it's really you don't really need that much long-short equity. It's going to look a lot like your existing portfolio. You probably need more diversifying strategies. And so I'd point someone to, in the perfect world, you have high vol, negative correlation, and high returns. Those things don't usually come together. So you probably have to settle for high vol and, negative correlation. The problem with that is those are the things that are going to increase your tracking error immensely relative to the 60/40 benchmark. So it's the right thing to do, but it's actually conversely going to add the most tracking error if you're, sort of how you measure it against your benchmark. And so you have to somewhat balance that as well. But, I'd naturally say correlation and volatility are going to be, and then if you can get a good Sharpe ratio with that, then those are the three basic things you'd want to look for.
Thank you, Jim and Cédric. I'm not sure if you would like to add that a little bit.
I mean, just to echo that, we try to add to those just a set of diversifying strategies, and they often include things like global macro and trend following. We'll build a bucket of those kind of strategies out to add to the 60/40. If you're the benchmark concern, I get that, but they want to see what the effect is on the returns, even given the period where equities and markets started to
Thank you. We also had 2 questions that we got prior to the webinar. So Linus, can you start with the first question that we got from our participants?
So one of the question was, where would you put your marginal new investments, and which strategies would you be looking to redeem from? Is that sort of it ties back to, I think, to the earlier question about sort of long-term versus short-term rotation versus superstars. Cédric, you didn't seem to be in that timing bucket, but maybe you have a view of where to put your next investment dollar.
I mean, we are clearly increasing the exposure to credit long short. So we were not in a hurry, but I think more and more the market environment for us is favorable to that strategy. And I mean, otherwise, we try to be more diversified in terms of the equity long short managers that we have in portfolios, in the sense that we want to be with managers that can play, a lot of different sectors. And we are seeing with the recent rotation we had in the market that, it's good to have diversification, I think, going forward.
Yeah, that was a pretty brutal sector rotation indeed. Justin, do you have any view on that? You seemed a little bit more timing friendly, but I might have misread you.
I actually would do the opposite. So I would be pivoting out of public long short credit strategies, or particularly more directional credit strategies. If you just take public credit, it's at a several hundred basis point. There is an observable persistent liquidity premium in private credit, and the fees are lower. So you're looking at 2 and 20 for, like, if it's mostly directional, you're paying 2 and 20 for lower spreads, and you could sort of go to 1 and 10 for higher spreads. So that's actually a pretty accretive shift in my view. It's a consensus call, but I do think as long as you're not in the upper end of sort of the private credit starter pack part of the market, and those jumbo deals, if you can go down a little bit into areas like specialty credit or sort of real estate where people have not gone as much, there's pretty attractive opportunities there. So I think we're doing that in our own book. We put private credit as part of our directional hedge fund book. It's everything that's not equity.
Maybe I should give Cédric a chance to counter that. Do you also do the private side of credit, or is it mostly semi-liquid hedge funds?
No, but you a good. You have to. We are starting from a low point in terms of allocation to credit long short, and it's more, the opportunity on the short side to come, basically.
All right. Jim, do you see the same? What's your view on credit, or do you see any other sort of sector that are sort of more opportune?
We're kind of constantly looking for places to get some upside convexity. And we think right now, given where economies sit, where markets sit, and where credit spreads sit, that credit is a likely source of some convexity at some point. And the question is how to play it. So we've had no credit, so something similar to Cédric, and we're now just starting to look at it and looking at it from that lens as where can we get exposure to some more normalization of credit spread in somewhat of a liquid fashion, but recognizing fully that being short credit outright is very expensive investment. We've done thoughtfully through some kind of derivative.
Thanks for that. Eric, did you have
One of the extra questions I think we would love to get an answer from in the little time we have left is the art of redemption, and what are the triggers that you and the sequences you go through for redeeming from a fund, even if it's performing well or if it's struggling, because you just might want to rotate out of a strategy because you're not optimistic, or you may see that trouble lies ahead and eventually you're not pleased with what's been going on and you think it's time to redeem. Can you just quickly walk through the touch points that you consider in the process of redeeming from a fund? Cédric, if you want to start with that.
Yeah, that's I think a really interesting question, because that's really part of our daily job. So to consider redeeming from a manager. So I will tend to say that it's really, again, each case is different. So you have to understand, what's going on if you are disappointed with a manager, because sometimes it could be also an opportunity to add, basically. Again, this concept of being contrarian, but that's specific cases, obviously. But then, yeah, usually we are gradual in when we redeem from a fund, because we try not to be in a situation where we have to redeem. Obviously, it can happen to everybody if there is really something wrong or unexpected. That's always possible. But otherwise, we are more on a gradual way to do that, so that, it's an ongoing process, and to reallocate to new opportunities. That's the way we proceed.
Jim?
Yeah, look, I think capital is valuable, and you have to put it where you think the most alpha is going to be on a go-forward basis. To Eric's comments, there's all kinds of reasons to redeem, and some are non-investment related and are very quick decisions to make, but you want to go through a decision matrix, particularly if it's return oriented, and so, well, why the returns come down? Is it going to continue in the future? Did they mismanage something? Often it can be a risk management issue. Sometimes it can be fixed, sometimes not fixed. I would say what I've learned in the 20 odd years I've been doing this is that often it's better to make a decision with imperfect information quickly that can results in the red, rather than not take any action and have to then speed up that red at some point to try to counteract that. So we don't try to knee-jerk react to things, but we like to make sure that our decisions are relatively correct. And we tend also not to therefore redeem partially. So let's say we have a 5% allocation, we're going to cut it to 2.5 and wait and see. Rather just cut it and then make decide both the base of it.
Okay, thank you, Jim. Justin, in answering the question, could you kind of give us a time frame typically that you might look at when you first start wondering whether you should maintain exposure, typically to when you might actually start redeeming or redeem in full? If you can give us a context, obviously not a clear example, a specific example, but just the experience of redemption when you question the actual continued performance and sustainability of performance by a manager.
Yeah, I don't think it's any different than any other employee. If they show up late every once in a while, well, like you're on the, you're kind of in this, I'm going to keep my eye on you. But there are fireable offenses. Like if you say something really mean to your boss when you're annoyed and you use profane language or something, you probably won't be there the next day. And so I think from those would be sort of things like risk management breaches, just really, maybe there was. So I'll just walk through our process. So the first thing is peer performance. In the context, most managers are, I think everything is beta. There's typically 4 or 5 managers and usually 10 or 20 that you can compare them to. So how are they stacking up? And that's usually a function of the opportunity set. And then if they're at the top or the bottom of that, was that a function of, did they just take less risk? So if AUM has gone up and gross exposure has gone down and their VAR has gone down, they're probably just sandbagging performance. So that's never a good sign. You're going to get in the weeds and say, like the same way you would with employee. Well, you didn't finish your project on time. What went wrong? Okay, well, you're going through something. That's fine. You had other stuff to do. Okay. Or you just, if you're lazy or you just weren't diligent, well, that's a different issue. And so you have to have tough conversations with managers and find out, well, why didn't you tactically allocate? You had this PM, you had this trade on, like you mistimed it. From a quantitative perspective, I think the easiest thing is just to have bespoke cone charts. And so you sort of forecast the expected volatility, which is generally quite stable for a manager. and then you have a return. And so like when they breach the cone chart, is it a 1-year breach, a 3-year breach? So if it's a big drawdown, they could exceed that cone chart quickly. And that goes back to the peer opportunity set, peer performance, and then the opportunity set. So there's certain times when like a market's dislocated, every manager in the space is dislocated. Maybe your manager is less or worse. There's times when an opportunity set's really good. Like one of my best performing managers in my book, like they made almost 20% last year, but they lagged their peers in that space. Kind of paying a lot more attention to them. And it's much more about like how did you perform in the opportunity that you had? And then I think the last thing is just, with most managers, there's some list of superlative qualities. Maybe they had something that they did that mitigated tail risk, or maybe they were more nimble, and because they're large, they can't do that as quickly. Like a credit manager, how do they adjust their net? Well, if they're large, it's going to be harder to move a couple $1 billion than it is a couple $100 million. So again, peer performance, opportunity set, AUM, gross exposure VAR, bespoke cone charts, and then sort of maintaining those superlative qualities. You put all that together and it's pretty clear whether or not they should be in your portfolio. And then, how big is the delta between if you can fire someone and rehire someone? If it's 1 or 2%, 1 or 2% on 5% is a few bips. But if it's 3 or 4 or 5 or 6%, then like that, as that delta starts to grow, there's a certain urgency that, an allocator needs to have to improve their net returns.
Thank you.
I think we are running a little bit out of time. So I would like to thank you all for joining. And also, of course, special thanks to our panelists for the incredible insight. And I hope that everybody finds this discussion very interesting. I apologize that we were not able to get all the questions from the panelists, but please feel free to reach out to Eric through LinkedIn account, ask any questions, and he's definitely going to respond to you. And again, thank you so much and have a wonderful day.
Thank you all.
Thank you.
Thank you.
Bye.
Okay.
Take care.